Talk Media Limited, where complex ideas are explained clearly. Hi, I'm TaxMax. Let's break down today's tax topic.
Quick tax fact before we start. Companies can still deal with income tax, even though they ultimately pay corporation tax. Companies are usually associated with corporation tax, not income tax. However, there are situations where companies must deduct income tax at source and account for it to HMRC. In these cases, the company is not the taxpayer. Instead, it acts as a collector of tax on HMRC's behalf. The legal responsibility for paying the tax remains with the recipient of the income, but the company carries the obligation to deduct, report, and pay the tax correctly. Failure to do so can result in direct liabilities, interest, and penalties for the company itself. The most common payments that trigger income tax deduction by companies are interest payments made to individuals, interest paid to overseas persons, interest paid to partnerships, unless all partners are UK resident companies, and royalty payments. As at September 2025, income tax is deducted at a flat rate of 20%. This applies regardless of whether the payment is an allowable deduction for corporation tax purposes. A common real-world example is where a director lends money to their company. If the company pays interest on that loan, and the interest rate is commercial, and the loan is used for business purposes, the interest is deductible for corporation tax, but the company must deduct income tax at 20% from the interest payment. The director is taxed on the gross interest and receives credit for the tax withheld. UK resident companies normally receive payments from other UK companies without tax being withheld. However, exceptions exist. For example, patent royalties received from individuals are treated as paid net of income tax, and partnership income may be received after tax has been deducted at source. In these cases, the company is treated as having suffered income tax, even though it did not make the deduction itself. Income tax suffered by a company is credited against its corporation tax liability. Gross income is included in the corporation tax computation, corporation tax is calculated in full, and income tax suffered is deducted at the bottom of the computation. If income tax suffered exceeds the corporation tax liability, the excess is not automatically repayable in all cases. Companies account for income tax deductions quarterly using a CT61 return. The standard quarters end on the 31st of March, the 30th of June, the 30th of September, and the 31st of December. Where accounting periods do not align with these quarters, a company may have 5 CT61 periods in a single accounting year. CT61 returns must be requested from HMRC and cannot be downloaded. For each CT61 period, income tax deducted from payments made is netted against income tax suffered on receipts. If deductions exceed tax suffered, the net amount is paid to HMRC. If tax suffered exceeds deductions, a repayment may be due, but HMRC will not repay more than the amount already paid for that accounting period. Any remaining balance is carried forward and may be offset against corporation tax at the end of the accounting period. Income tax shown on a CT61 is due 14 days after the end of the quarter, whether or not an assessment has been issued. Where HMRC raises an assessment, the tax is due 14 days after the notice is issued. Interest runs on late paid tax and is deductible for corporation tax. Interest on overpaid tax runs from the day after the end of the accounting period in which the income was received and is taxable for corporation tax purposes. And this brings us back to the fact we opened with. Even though companies ultimately pay corporation tax, income tax can still be deducted along the way. The rules exist to make sure tax is collected at source while still allowing companies to credit that tax correctly against their corporation tax bill. HMRC doesn't mind who owes the tax, as long as someone remembers to deduct it. Educational disclaimer: this content is general information only, not tax advice, and tax rules can change.
Educational content only, not advice. Rules can change. Thanks for watching. Clear explanations, one place, Talk Media.